Hey everyone, welcome back to a little bit delayed market open. I have to say that it was really awkward when Jack Palantir, sure. Palantir. Oh, skills. I did say I was going to do skills. It's only 7% on Palantir. What's the ticker here? Skills, Riot, and Marathon. Yeah, maybe. Where's the skills ticker? Dang it. Hold on. All right, 3 more. That's it. That's it. Skills, Mara, and Skills, Marathon, and Riot. That's all. That's all. That's all, folks. That's all. Okay, so 16% on Skills. Mara is Mara, whatever, 5.69. Riot. 37% on Riot. Wow. Wow. Yeah, that's interesting to me. That is. Okay, so we'll keep an eye on Clove. Again, as a long fundamentals, I don't know. I don't know. I don't know about that one. But in terms of screwing the shorts, I can play that game. It's a dangerous game to play, but I can play it. All right. Focus. Focus, Kevin. Focus. I got to focus. I'm not focusing anymore. This just happens later in the live streams. We just start having too much fun. All right. What else we got? So, all right. Discovery, Pinterest, Voyager. These guys have actually stopped being as painful. Little bit of a recovery in the market. Yeah, a little bit of a recovery here. This is what we got. Not everywhere, but definitely some things are showing somewhat of a recovery. MP Materials pretty bouncy here. Matterport. Yeah, Matterport's recovering a little bit as well. Tesla's still down 3/4. Churchill went positive. Oh my goodness. Very good. It's only at 1%. Yeah. Clover's at 21%. It just wouldn't shock me at all with that kind of short interest. I don't know. Like I think you could probably see a big move there. And I have no idea. But it's the lowest it had gone. Let's do a little bit more TA on it. So let's go to the hour chart for TA here. So we previously ran to 942 a few days ago. And then we kind of slowly deflated again. We've kind of been on this down trajectory for a long period of time on Clove. This is the hour. Let's go back to the week here. Clove historically has gotten to a high of like 13. $10. Oh no, here we go. Went to 17 for a period of time. Yeah, okay, so that's its high. This was its high flyer over here. It was between 17 and 14. But it's really at near all-time lows over here in the 8s, I feel like. Because let's draw a line at where we bought the thing. What, like 870 or whatever? I just want to compare. I know this is like after action, but whatever. 8 something way up here. Yeah, so a little rich maybe where oh oops, where it was bought just recently, but that's okay. So what was it, 870 something like that? Yeah, like right there. Okay, so let's zoom out a little bit. So comparing that pricing to the day chart, we haven't really been under that. No, we've barely been under that. I mean, in fairness, in the history of the stock, it's never been as low as it has been in the last month here. It's just been getting wrecked the last month. I also don't think we have the capacity to go down to 631 again, because that was when we had the March crash. So, is it possible that this thing bobs back down to support levels around maybe bounce off like a 690, maybe like a 713? Yeah. So I think the downside risk is probably what, at 870, maybe a $1.50 downside risk. But I think the upside is potentially I mean, as much as a double, but no guarantees. That's the highest we'd ever gone, would have been about a double. All right, now they're talking about SPACs and IPOs again. Let's listen in on this.
Markets,
Let's
and
get
what
off
does it
slow
mean
a
for
sec.
tech darlings like Robinhood, which already face headwinds from potential regulation? That's where we'll start with Jason Calacanis, TechInvestorInside.com founder, Robinhood angel. Jason, I remember, what was it, a year and a half ago, Bill Gurley was gathering with investors in Silicon Valley saying direct listings are it. They're for everyone. They're the future. I mean, that's not what's happened here. Is it a better public debut and IPO market than it was, though?
Well, I mean, we had an IPO window that was closed for what, a decade, and the idea that companies would go public, during that 2010 period, wasn't even on the table, and we weren't even talking about it in Silicon Valley. And Bill's been at this for a couple of decades, 3 or 4, in fact, and we now have this opportunity.
This is, by the way, the guy in the Chamath podcast.
What a savvy founder does and what a savvy board of directors does is when the market is hot, you raise capital and you deploy it when the market is not hot, right? And so the smart move is really to raise money now and deploy it whenever there's a pullback. Those dollars that you raise now could be worth 2 or 3 in the future. And we saw that at the dot-com bust. We saw it in 2008 in the Great Recession. So here we go again. We're at a peak market and it's going to correct at some point. And the smart move is to get public now and to ride it out.
So
now that we have 2 choices, direct listings and SPACs, that's nice that there's
2 more
multiple
choices.
options.
Is it healthy? Is it good? Because, I mean, I see companies coming public through SPAC. It seems to be a lot of the smaller companies usually. I mean, Grab's an exception here. There have been a couple other exceptions, but it's the type of companies that 20 years ago we saw coming public early in their life. And yeah, ordinary investors had a chance to do some analysis, maybe make a good buy. Like everybody looks now at Amazon, and even Jeff Bezos was touting in his shareholder letter, the couple that bought it really early. I mean, sure, there are a lot of bad SPACs out there, but there's some good opportunities.
Yeah, absolutely. And people are looking for some kind of alpha, some kind of return. People want to get big returns. People are not interested in making 7 or 10% a year. People want to make 7 or 10% a day, a week. We've kind of lost the script here. And so,
hey, tell us more about eHang. I appreciate you're an aerospace engineer and understand the potential and fundamentals. Tell us more.
It's failed 2 or 3 times, and now they're SPACing again. Like, how many times does that brand need to fail for people to not buy the stock? And I'm not dogging just on them. There is a...
Wow, Mike thinks Doge is going to 420 on 420, and Tesla will announce you can purchase with Doge. Wow.
Ford and GM and everybody catching up there. So, buyer beware, do your research. And if you want to play in the private market game, in overvalued SPACs, and many of them are overvalued, you better be in it for the long haul, and you better do your research. And now, if you're buying Netflix or you're buying Disney, and they have 250,000 people subscribing to their, service, you can feel a lot more secure. So this is the great education that has to occur, and that's part of what CNBC and these online discussions. This is why they're so important. Is for us to say, Netflix and Disney are different than Fisker and Nikola. It's very, very different. When a company does not have a product in market and they become worth billions of dollars, right, like this company, Theranos, I always save this t-shirt, it could be a fraud. It could be a zero. It could be incompetence. Or, maybe there's a chance that you happen to hit lightning in a bottle.
Right, and some key differences, right, between the traditional IPO and the SPAC. So, Jason, for SPACs, who's doing the due diligence, or who should be?
Yeah, well, I mean, obviously, anybody who buys the shares and anybody who's involved in the company or anybody who's involved in the deal should be doing diligence. So everybody from a retail investor
what about the
to the promoter.
Role?
Yeah, of course, the promoters are super responsible. And so,
but
if
Jason,
you look at somebody, hold on. You asked me a question. Let me finish the answer. If you're looking at somebody like Chamath, who is active and who is at the top of his game, and obviously we're besties, so take it for what it's worth. There's somebody there who's going to be keep working on this for 20 years. Then you have people who are retired or who are celebrities, and those people are very different. Yeah.
Okay, but Jason, you bring up Chamath. And so he was the sponsor. He did a lot of this due diligence, but he's also selling shares. The person doing due diligence is also the one selling. Isn't there a conflict of interest there? Do you think that there needs to be a longer lockup period? You say that he's in it for the long run, but not really putting his money where his mouth is.
Well, I mean, I think it probably depends on the company, and all of this is public information.
Well, I'm talking
right?
Virgin Galactic, and you saw Richard Branson do the same thing.
Right. So I think if you see a company where people are selling, you have to dig into that and understand why they're selling and if they're bullish on it or not, or things have changed. So, Goldman's taking companies out, Morgan Stanley's taking companies out. Everybody's going to take companies out. And then, it's a great idea for people to have to hold for a period of time. Sure. And that's part of this push and pull, in the ecosystem. Me as an early stage investor, I really hold my positions for 10, 20 years. And so people who want to be an LP in my funds or work with me know that I have that philosophy. Other folks are taking things public. They bring it to market. It's up to you to determine if you want to be in this. And so the things that get me concerned is obviously not Chamath selling some of his Virgin position because he's doing so many other deals. I would be more concerned about a celebrity or a retired person coming out of retirement to get that one last payday on a company that doesn't have a real product or doesn't have customers. So, but it is your responsibility.
Yeah, Jason.
I know talking about personal responsibility is something we don't do anymore, but if you're buying Bitcoin or Dogecoin or SPACs or any stocks, it's your responsibility. Just like it's your responsibility if you go to Vegas and you put it on black or red on the roulette table.
It's a great point. I mean, we're here to help you understand, but we certainly we don't want to be in the business of being a babysitter. You're gonna make those choices for yourself. I do want to ask you, Coinbase was yet another example where viewers wrote in and said, aha, here we go again, a name that I would have loved to have gotten into earlier. Instead, I'm gonna have to watch it pop $100 at the open, and it's gonna be too expensive for me. You talk about risk tolerance. What do you tell those viewers?
I had this conversation recently with somebody very close to me, and I said, if you love the company and you were going to allocate $10,000 for it and you're passionate about it and you believe you're going to hold it for a decade or two, dollar cost average, you could buy it 3-4 times over the next year. We know these things are volatile. We saw Uber, which obviously I was very connected to, go down to $15, back up to $60. This is a pretty volatile market. And if you believe in the company, you believe in management, slowly get into the company. Now, you look at something like Coinbase, Brian Armstrong is the real deal. He has been an advocate and he's made cryptocurrency really easy for people, right? So he has really done a tremendous job there. But keep in mind that there was a perfect storm for Coinbase. Stimulus checks being dropped everywhere, people not being able to bet on sports, and a pandemic where nobody could go out and spend money on a vacation. That's all going to reverse, right? So now we're going to have the opening. People are not going to be spending their money on crypto as much as maybe going to Coachella. And so that crypto to Coachella transition could be bumpy for them. So, but I do think they will be I do think there's a chance they'll be Google. They'll be Google. But they'll be the Google of crypto.
I keep hearing that, and I push back with, how do we know they're not the Yahoo or AOL, because they are early? And I wonder this about the narrative, because you're an investor in Robinhood too. It seems to me that part of the Robinhood narrative is the retail investor doesn't like fees. Easy access is good. The competition is good, right? But then at the same time, you've got Coinbase that's got some pretty high fees. And the argument is that somehow they're going to be able to maintain that and maintain the margin. Can both be true, or is there going to be this difficult period where Coinbase is probably getting hit on those fees decreasing from competition, and maybe it's not clear yet what platforms they're going to be able to build on for the future?
Yeah, there's really two parts to that question. One is like the cult of imaginary money, and can that sustain itself? Is it a giant Ponzi scheme, as some people believe, or is it the future? Let's put that question aside. To your point of, is it Yahoo or is it Google? Is it Tesla or is it Fisker, et cetera? I think as long as Brian is in the pilot seat, this is a Google, this is a company like Facebook with Zuckerberg, you have that founder authority. You mentioned AOL and Yahoo. When they took Steve Case out, when they took Jerry Yang out and David Filo, those companies were run by professional managers who ran them into the ground. And I think Yahoo had 5 CEOs in 6 years or something insane like that. So I always look for the founder authority. I think that's the big tell. If you have a founder running the company, Steve Jobs, he leaves for Next, he comes back, you see the correlation. So as long as Brian's running the company, I would be pretty confident in it. But I do think there's two games being played here simultaneously. There are people who've been in the markets, and we look at them as like this, beautiful cathedral with rules and decorum and a process. And I think CNBC and the venture community and private equity, we all kind of fall into that bucket. And then there's people who look at this as betting and recreation. And they are playing a metagame they look at shorting stocks and coming over the top and GameStop and Dogecoin. This is all a big joke and fun to them, and it's gambling. So they're betting on sports. They're in a casino having drinks and having fun, and we're all taking it seriously for our retirement. And these two things are happening at the same time, which is why there's this confusion.
Jason, that's a great way of breaking it down. I give you credit for that one. Is there anything more representative of that betting recreational sort of fun side of gambling or playing the market than Dogecoin, right? We've seen this enormous spike this week, but I wonder, are there people who aren't understanding the joke, whether that be on the institutional side, who could see this as part of a problem with the wider system, or, the retail investor side that think it's an actual investment?
I have been on CNBC with you sounding the alarm, asking people to please be careful, to keep 1% or 2% of their net worth in these things, not 90%. We have Pomp on, who's a Bitcoin maximalist. He's got 98% of his net worth in Bitcoin and just one cryptocurrency. Like, my message for all those folks is buy your house, put the maximum amount into your 529 and get your kids' education paid for. And then, make this half or a third or 10% of what you're doing. But, you can't stop people from doing what they want to do. This is a free economy. You get to place bets if you want. And part of the fun they're having is watching us react to this. They love the fact that we're sitting here going, why would you buy AMC and GameStop? These companies are dying. It's a pandemic. This makes no sense. They like that. And now it's become manifest destiny. AMC is going to raise a bunch of money, and GameStop might actually figure this out.
Yeah.
So now it's become this crazy cult religion, and they're empowered. So what are they going to do next? Bring back the Palm Pilot? I mean, it's getting crazy.
Hey, it could happen. and never said it wouldn't work. Just said recognize the risk. That's the beauty of the market. If you see the chance, you can take it. And you, Jason, always keep it 100. Love that. Love to have you help.
Buy Disney. Buy Disney. Please
week.
own some Disney. It's not going anywhere.
Yeah.
Captain America will be here in 50
investor.
years.
Says the angel investor. So you do your share of risk as well, Jason. Thanks.
Yeah. I like Disney too.
Thanks, everybody.
Today's
That was good. That was fun. That was a fun interview. Yeah, I mean, he's got some really good points. I like his thesis. Look, you invest for 20 years, and it's one of the things I talk about too. Is look, if you're gonna buy shares, you should have almost a written strategy, which is I'm gonna buy something, and it's a trade. That's one thing. I'm going to buy something and it's a long hold, then let it be a long hold and don't worry about the pricing in the short term. We've got, let's jump on over here. So we've got, Pinterest is down rough today, but long hold for me. And it's over our targets of $70. I like buying it under 70, so it's still fine. It's obviously given up a little bit of the excitement here recently. Playboy's down a bit, but it's also up a lot in just the last month. Really incredible when we saw that. Saw Marathon down again here. Bitcoin plays, or crypto plays, I should say, not doing very, very well here. Let's see, Square's even down today at 1.85%. Lemonade's at 86. Hey, we're almost at 90. Let's go. Or sorry, 80. We get to 80. That might be interesting again. Palantir's down again now, 22.83. Wow, lots of pain in the market. Look at that. Tesla is accelerating its losses here, now down at 0.85. Matterport down 0.7. What else here? Apple down about 0.4. Churchill was green in the day. Now it's red again. It's incredible, just the amount of movement and fluctuation we see in this market. Really incredible. So Coinbase. Oh, hey, look at Coinbase, though. And Clover, which we found out now is 148% short, which is kind of crazy. But Coinbase up 4.5% all of a sudden. Nice run finally at Coinbase at 337. Never really got down to my my ideal of 315 to average down a little bit more. 322, 321. Yeah, that's kind of where the thing just been about. Look at that. Got to 318 for a hot minute. 317, 317, 316. Oh, in the aftermarket, 315.62. Never hit my number though. Never hit my execution of under 315. That's funny. It got really close. Oh well. Well, now running a little bit. Cool. All right. Awesome. So yeah, I think that about does it for today. So folks, thank you so much for being here. Appreciate y'all. It's always fun having y'all. Super weird on Clove, by the way. I just have to say 148%. That is, why is it so short? It's already so cheap. How could it be so short? I don't know. I don't get it. Anyway, folks, thank you so much for being here. We will see you in the next one. And that'll be when the market closes. Thanks. Bye. Hey, everyone. Welcome back to the Meet Kevin Show. Today, Meet Kevin meets Kevin O'Leary, investor, entrepreneur, of course, Mr. Wonderful. I am super excited to ask a ton of questions about what the heck is going on in this crazy market and world. Please welcome Kevin O'Leary. Hey, Kevin, how's it going?
Great to be here, Kevin. I love this Kevin Squared thing. It's great.
I love that. Absolutely. So, Kevin, I want to get right into it. We had CPI data this morning. It wasn't as bad as expected. What's your take on inflation? Is the Fed going to lose control or are they going to maintain control? What's your take?
I think the Fed's been pretty clear. They are focused pedal to the metal on keeping rates at basically zero until they can get these last 9 million people replaced in the economy, redeployed. And I think everybody's beginning to realize, it's happening very quickly, that the economy that we're trying to stimulate back doesn't resemble 2019 or 2020 anymore. There's been this incredible digitization that's occurred during the pandemic, where now the entire economy and purchase preferences as well with individuals has changed. It's very much direct to consumer. All kinds of new business models have emerged. Retail has taken a back seat in terms of how products are sold to people now. All kinds of fundamental changes going on in business travel, what's happening in terms of expenditures in the S&P 500 companies right down to small, mom and pop businesses. And we don't yet know what it looks like until we get out of this pandemic. So as far as the Fed's concerned, they're focusing on all the people that lost their jobs, for example, in business travel and airlines. That's 10% of the employed people somehow involved in that chain in America. All the people that lost their jobs in movie theaters that were cineplexes that nobody wants to go back to anymore. All the people that lost their jobs in restaurants and food services businesses have to be redeployed by the new digital economy, whatever that looks like. And that's why you're going to have a current focus on that for at least the rest of the year. And that's extremely constructive for stocks. I mean, we've never seen anything like this. I have never, ever seen data like what I'm seeing now. In Q4 of this year, we may achieve past the 9% GDP growth. You haven't seen that since the 1950s.
Golly. Yeah, it's absolutely incredible. Just the growth projections. I believe they're thinking if we add together 2021 and 2022, we could be growing like we were growing in 05, which a lot of folks don't want to hear 05 because what came after that, which begs the question, is it possible that if the Fed keeps the Fed funds rate so low for so long that we end up letting the inflation genie out of the bottle? I mean, I've heard you yourself say, hey, we shouldn't be spending all this money.
Yeah, I think a lot of the expenditure is wasted. That's because it's such a blunt instrument. The $1.9 trillion package that already has been legislated, I would say 50% of that will be wasted. The infrastructure package is more interesting, but we don't yet know what that's going to look like. And it may have the detrimental impact of raising corporate taxes again, which makes the U.S. uncompetitive. The idea that Yellen can run around the world asking for a standard minimum corporate tax is a joke. That's never going to happen. The Asian markets, which are very, very tax efficient in terms of low taxes, are killing us in growth. They're just really getting competitive, and they have no interest in raising corporate taxes, to kill that golden goose. So we will, again, if this tax proposal is put through, be the highest corporate tax jurisdiction in the world in terms of the G7, and you'll start to see all the inversions starting again, companies making moves to get out of the U.S. So I'm not sure they're going to be able to do that easily. So that's a big question mark. Regarding inflation, you have a bellwether every day. You simply watch the 10-year. The 10-year bond will not be competition for equities until it has a 3 handle in front of it, which is a long time from now. We're about 1.6. So you're going to stay the course on stocks because that stocks actually do well in inflationary times. They tend to actually have pricing power. And corporations do very, very well when inflation comes into the economy. It's runaway inflation you don't want. You don't want to turn America into Venezuela or Cuba or something like that. But I think we're a long way from that right now.
long way from runaway inflation. That's a fear that a lot of folks have, is that we might see that kind of hyperinflation, that we're going to that essentially the country is debasing the dollar, and that we can't trust the dollar anymore. And that's maybe why you see a run into cryptocurrencies. Is that not something that you believe, that the dollar could lose its value, or potentially even collapse, or lose its status as the world's reserve currency?
Well, there's some speculation. You saw a lot of pundits talking about this week, that China was really trying to promote cryptocurrencies as a way to getting out of under the mat of the dollar. Because the truth is, the Chinese economy is based on the US dollar, in the sense that everything outside of their economy settles in USD. Nobody wants to take the Chinese yuan and hold that long term. They have no idea what the policymakers are going to do with it. So if you want to do business out of Hong Kong or out of China, you ask to settle in US dollars. And that's really what the Chinese are frustrated about. What they prefer to see is a cryptocurrency, perhaps one they bring on themselves, which I would never take into custody, because the Chinese could simply turn it off if they weren't happy with you or something you said about them, or Bitcoin. And that's why Bitcoin is at a new high today. No government controls it, but it does have its own issues emerging now. So we've got a very interesting time going on here. We're basically, and I think the best way to put it, in an economic war with China. China doesn't play by the rules, doesn't give us access to their courts, does not give us access to the middle class. They use American courts to litigate their own IP domestically and sell tons of products into the largest economy on the earth currently, which is the US economy. And until that playing field is leveled, we're going to have tremendous tension with that regime.
China this morning came out and said that they want to play nice with Biden, in so many words. It sounds like you don't believe them.
No, I don't. I just look at the last 10 administrations and how crafty they are in making nice, sounding nice, and then keeping everything the same as before. The only thing the Chinese understand and respect is the stick. That's what they understand. And so you can look and back for the last 5 administrations and realize, until the last one, where they really put the pressure on them, nothing was changing. The idea that you can form a cohort of American and European economies to work together to bring the Chinese to bay is not going to happen, because in Europe, basically 25% of most of those economies is tied to China. So while they'll give lip service, they don't want to in any way taint their relationship with a quarter of their GDP. That's why it never worked. The only time now is to go hardcore against China and say, look, we understand we're in a competition. We understand the playing field is not level. So let's level it. And the way to level it is to say, let's make it level right now. What would that mean? Delist all the Chinese stocks. Do not give them access to our courts. We don't get access to their courts. Make it the same for both. Then build it back up. When the Chinese feel the pressure of that stick, they'll understand they have to somehow raise the bar. Now, that sounds torturous and difficult, but it has to be done. It has to be done. It makes no sense to me that an American manufacturer has to give up their IP, basically have it stolen. That hasn't changed. You've heard a lot about it from the last administration, but it's the same. The Chinese people are not at fault. It's the policy of the Chinese government that is causing these tensions. And it's really time to address it now. Now's the time, because if they become bigger, which they will in the next 20 years, you won't have that leverage anymore. Remember, the stick is what they appreciate. The stick is what they want. The stick is what will work.
The stick is what they want. I mean, the stick is generally associated with sanctions. I don't believe that China wants sanctions, but it sounds like that's what you're advocating.
No, I'm beyond sanctions. I want to take them right out of the financial system of North America. They don't get access to it. It's that simple.
So Alibaba, Neo, Xpeng, delist.
Sure. You know, the economy is so large, and there's so many other places to deploy capital in those markets. It'll find a way. Or if you insist, you can simply go buy those shares on the Hong Kong exchange or whatever exchange it is, but it'll make it much harder for compliant institutions in the US to do business with them. And also, you know, frankly, that stick will really put some pressure on them to solve the problem. My assumption is you have a few rough quarters when you do this, you implement it, but then we get to what we want, a really collateral discussion with them about leveling the playing field. America can compete. China can compete. Just level the playing field and let the competition begin. But don't keep it in this unbalanced football field where it's so unfair for other economies that don't get access to the Chinese economy. If they want to play with the big boys, They've got to play with a level playing field. And if it takes a little pressure to get them there, that's okay. The stick works.
Now, what do you think about Tesla? Tesla is one of the first manufacturers in China, U.S. manufacturers in China, many ownership in their company to China. Do you think that this maybe sets a precedent for maybe there is a nice way to play with China? Maybe we just got to do the Elon Musk way.
Yeah, absolutely. I mean, that is the right direction, to go into partnership, to actually have access to their middle class and sell cars to them. Why not? Elon Musk is a maverick in terms of what he does. He doesn't play by the rules, obviously, but he's actually a good designer of how this relationship should work. If American companies, if Boeing wanted to go to China and build planes there, they shouldn't have to give up control of their IP to do that, and that would help the Chinese economy. If think about all the technology they can actually provide for that growing economy, and in a partnership way. I don't know why they're not discussing that, but that's the kind of potential that we could have across all kinds of different technologies. And also, when it comes to pandemics, you really have to ask yourself, why do so many of these originate in China? I'm not pointing fingers. I'm just saying, if we're more cooperative on biotechnology, we could stop them in their tracks and save billions of dollars, millions of lives, and be cooperative on that basis. Again, the stick is the way to go.
Do you believe that the Biden administration will change anything over the next 4 to 8 years?
I think the Biden administration is focusing on what they said in terms of their mandate to get every American vaccinated that wants the vaccine. And we're in the throes of that. We're probably in the 6th inning. They've done very well in execution of it. A bit of a setback today on the J&J vaccine, but that doesn't mean we can't keep going. We've still got 2 other alternatives. American ingenuity and technology brought these new medicines out of Moderna and Pfizer, and that's tremendous. But at the end of the day, that's the focus of the administration. When that's over with, then the infrastructure package comes, and somewhere along the line, he's going to have to address China. Now, I'm glad to see he did not take off the tariffs that were put on and hard won from the last administration. Like them or not like them, the policy was very, very good for the American economy to start pushing back on China. But I think he can use that and continue to lever it. But at the end of the day, the Chinese are very, very good at playing one administration off against the other, because their leadership is for life. That's not how the American economy works. You get these 4 to 8 year cycles, and they've learned how to play that ball. They'll immediately say, let's have a meeting, let's get together, let's talk about our future together as friends, and nothing will happen. You got to go to that meeting with a stick.
Wow. So I want to go back to something you mentioned earlier here, was this digitization of our economy. There are a lot of folks very excited about investing in recovery stocks, which obviously have done phenomenally since the election, the recovery of even the Macy's, the Nordstroms, and the airlines. What's your take? I mean, is this a sector that you stay away from? Is it a value trap like Kathy Wood says? What's your take?
No, these are not stay-at-home stocks anymore. These are work-from-anywhere stocks. And so what you're starting to see happen up and down the S&P 500 is that companies are realizing people that work in accounting, compliance, or logistics, who used to work in cubicles at HQ, do not want to return to those cubicles anymore. And that represents about 15% of the workforce. They're asking for more flexibility in lifestyle. Maybe they're raising elderly parents, maybe they're raising children. They don't want to do the commute, but whatever reason it is, we now have proven technology that allows them to work efficiently and productively from their homes. And so you're going to start to see these stocks become the bellwethers of the new generation of digitization. They're the ones that have allowed a global, move to e-commerce. And it's not just domestically. Zoom, for example, CrowdStrike, DocuSign, Adobe, Microsoft licenses, Shopify. These are all the tools that are used to digitize America, whether you're Nike or whether you're a small business around the corner. And companies like Facebook allow for geo-locked advertising. There's so much of this technology that was put to work over the last year that's proven to be very, very productive. And in a way will change the cost structure of the American economy to the positive. I'll give you an example. You don't have to fly to Bentonville anymore and spend 2 days to meet the buyer at Walmart, the world's largest retailer. You can do it on a Zoom call, get 18 minutes, and the buyer themselves are 20 or 30% more productive. And you save thousands of dollars in business travel. Now, it's not good news for the airlines, because even though they're coming back, it's all basically vacation tickets. So $248 was the average ticket last week, including the return travel. That means everybody's going to Disneyland in a big tube. That's a very crappy business. They won't make any money. And as a result of that, those airlines over the next 2 years, probably a couple of them have to go bankrupt and consolidate capacity, because business travel is permanently impaired by maybe 15, 20%. But there's nothing wrong with airlines going bankrupt. They're very good at it. They do it every 10 years, and they reduce capacity. And that's what the Fed is worried about. All the people who displaced, they're highly trained employees. We've got to find a way to redeploy them. Maybe it's going to be cloud kitchens. Maybe it's going to be pick and pack storage. Maybe it's going to be all kinds of new digital reasons to exist in the new digitized America 2.0. But we've got to find them jobs.
Wow. Wow. So of airlines that could go bankrupt, any particular ones you look at, or you're looking at the most highly leveraged ones, or do you think a company like Spirit could be the one that wins because they don't cater so much to business and they cater more towards the Disneyland traveler?
Well, all the balance sheets are upside down, and a combination of loans from the government and debt they went and raised on their own in the open markets. The Fed kept the debt markets liquid. So the deterioration of even one of the strongest companies in the airline industry, Boeing, that balance sheet has been decimated. There's billions and billions and billions of dollars of debt on it. Now, I'm not saying Boeing will suffer the slings and hours of the operators, because they're one of the companies in the world that makes airlines, and we do need them. But the airline industry itself is gone through a massive change. Really, it's just a bus now, a bus to move people around to their vacation destinations. The business travel component, while everybody's so optimistic about it, I don't see it coming back. A lot of it will, but not 100%. And that 15, 20% was where all the profit was. When you paid, $5,000 for a trip to Europe on a business class or first class seat, nobody needs to do that anymore. So you go there for a vacation and you do it for $999. The airline makes virtually no money doing that. They're just filling up tubes. It's a miserable business, but that's okay. You've got 11 sectors of the economy. You don't have to focus on the losers. You can focus on the winners.
And the winners sound, like you had mentioned, sound like the Adobes, the Facebooks, the Microsofts, huh?
Yeah, I think technology is a good bet and will be. It's got volatility, but people say to me, "Oh, it's over for the Zoom stocks and the Shopify's." No, it isn't. They're in their second inning. It's hilarious. If you look at the volatility of Amazon over the last 20 years, you would have never owned it. It's so volatile. Some years it goes down 38%. But in the long run, it's created $1 trillion worth of value for shareholders. Same thing's going to happen to these economies and these stocks that are going to provide digitization. Another sector which I really believe in now is healthcare. I think we're going to domesticate all of drug manufacturing, hazmat materials, medical devices to Puerto Rico, to Canada, to Mexico, to North America, so that we're not beholden to the Chinese when it comes to a pandemic, because we don't know what COVID 20, 21, and 22 are or when they're going to come, but they will come. There's no question about it. We need to be ready for that, and obviously use our technology to protect us in a way we hadn't thought of before. So that's another one. And the consumer, whenever you sprinkle 1.9 trillion free dollars out of a helicopter, just throw it down at people for free, the consumer spends it. So I think they're going to be very, very strong in the next year and a half. So I like those sectors over, let's say, energy or airlines or anything else, frankly.
Got it. Now, Biden, of localizing production, that's a big priority of Biden. For example, even with auto manufacturing, wants to use American unions to build vehicles in America. What's the possibility, though, that using American labor just ends up shooting prices sky high, and then people have to default to Chinese or Japanese-made vehicles, for example?
Yeah, that is a big problem. Biden is in a bit of a pressure squeeze on that one. It's great. The only way to make the American economy self-reliant and sustainable long-term is to make the economy competitive globally, so that all people that want to invest in corporations from all countries and all jurisdictions come to America, like they do to Vietnam, like they did to China, like they do to Asia and Singapore, because those economies are very productive, very low taxes, extremely high growth, and have very good domestic markets as well. So the problem he's got is, the rhetoric from the left side of his party to tax the rich and take all the money away from people and disincentivize entrepreneurship in America is not a good model, because that's not going to get people saying, "Gee, I can't wait to invest in America, the highest corporate tax rate in the world." That's just not going to happen. And so I think that debate, even within his own party, is going to be very tough. Now, what happens, because I'm a bit of a policy wonk, midterm elections are a bit of a problem for Biden, because every incumbent, regardless of party, loses seats in the midterm. It just happens that way. So he's on this really delicate razor wire balance, given that he's sort of got the ability to do this if every one of his party members agrees. And that means he has to get it jammed through in less than 24 months. I don't think it's going to be that easy. I think it's going to be hard fought. I think he's going to lose seats. He probably knows it. So it's better to come in with a more moderate, middle of the road strategy and leave the massive tax hikes for afterwards. At some point after the economy is running at full throttle, back to unemployment under 4%, like it was prior to the pandemic. And I think that's a ways off. So I think you've got a really interesting political scenario coming. But if all of a sudden he jams up corporate tax rate to global highs, the economy just sputters out. That's what will happen.
Wow. Tell me about this. So you actually think, despite us stimulating as much as we are, just that corporate tax increase could be enough to sputter out the economy? Could you define that a little bit? What are you saying?
Sure. It's a very simple equation. You're pouring free money out of the sky from a helicopter into anywhere you can stuff it, okay? But then you're raising taxes, so you're taking it back right away before it doesn't have a chance to have any effect whatsoever. You're asking people to pay more tax and corporations to pay more tax. What was the point of the free money then? I mean, that made no sense. You're basically letting it fall out of the helicopter, and immediately the taxman grabs it. It's before it does anything. So that really makes, you can't suck and blow at the same time. It doesn't make any sense. And that's really the bottom line. That's the problem he's got. Because corporations don't have feelings. They don't have emotions. They can move overnight. People tend not to want to leave their families. So maybe the U.S. has to start considering what the Europeans did, a value-added tax that taxes usage, but doesn't tax necessarily corporations. Frankly, in some ways, the Nordic model works better, the Swiss model, where there's basically no corporate tax. They just tax